Today's title of the MCF Perspective Moment is Uncertain Times. We all agree that these times will be permanently embedded in our memories. Several weeks ago, life seemed to be chugging along. Then whammo, change, uncertainty, hardship, and fear are mainstream. I'm going to take the next few minutes to share some of my experiences over the past 40 years, which has impacted my perspective. I started my professional career in June of 1980. The following is a listing of some of the financial events that are embedded in my memory bank. September 1981, U.S. Treasury bonds peaking, yielding at 15% per year. Wow. Inflation, 13%. Wow. Today, the 10-year Treasury is less than 1%, a bounce back from a low 0.5%. That's another wow. The Dow Jones average hitting a low of $800 in the summer of 1982. Today it's at 20,000, down from an all-time high of almost 30,000 recently, just a few days ago. 1987 U.S. stock market lost 20% in one day. It's now labeled Black Monday. I remember exactly where I was at that day. Within those 5 days in 1987, the stock market lost 34%. I remember the huge bull market of the 90s, and of course Y2K fears, and the following bust in 2000, markets losing 50% plus of their value. The 9/11 terrorist attacks, which feel like today, an unknown force from the outside coming in. 2008 and 9 Great Recession, with the markets losing 50% again. Business closing, unemployment of 15%. The longest non-recessionary economic run in the United States has just ended its 11-year ride. U.S. stocks are down 32% from the February highs. Energy prices and interest rates are both crashing, trying to give us consumers a break, but temporary hold on our daily life pattern is taking over and in place. Well, I could certainly go on, and each one of these trying times, we're shaken to the core, and we're tempted to lose faith. We search for other opinions rather than staying solid on our own understandings. Fear is an amazing human trait. I can't think of any good decisions made under duress or fear. Rationally, we know that. So, try to get some perspective before making important decisions. Many businesses and individuals will be struck hard during this current COVID-19 pandemic. Loss of income, financial casualties of large and small businesses are rampant. We're all exhausted and stressed. On top of that, we're experiencing one of the worst weeks of the stock market declines in modern history. 2 of the largest one-day drops in our history has occurred within the most recent days. See the chart. You notice 1987, I referenced 20% drop in one day. And then number 3 was just a week ago, March 16th, 2020, lost 12%. And another on the radar screen, March 12th of 2020 at 10%. So 2 of the last 10 have been within the last week. So let's try to evaluate where the stock market might bottom. Well, this involves creating some framework to assess the assumptions in the market, the business sustainability, cash flows, and balance sheets of the companies in which we invest. My perspective is that the financial markets are always ahead of Main Street, perhaps by 6 to 9 months. Markets are a leading economic indicator. In 3 weeks, the world's capital markets have priced in very severe economic decline, and likely so. However, it will take the economic decline at least 6 months, if not 9 months, out on Main Street to play out. But by then, the markets will likely be focused on 2021 and beyond. Many have asked me, well, where do you think the bottom is? You think it's going down another 30%? Should I get out? Should I buy? Should I, and many more situational questions. And my response for almost all the questions has been, I really don't know what the markets will do in the next few days. But I can tell you that today, forward investment returns for the publicly traded stock markets are quite attractive from these levels. Let's look at the chart. The current price is down 32% from our high just a few weeks ago. This just goes back 10, 11 years, and you can see we're back to about the 217 era mark. So it's quite a quick drop. This drop reminds me of 1987. At the current price of 2,300, we're at 32% below the February 19th peak of 3,382 on the S&P 500 index. The S&P currently trades at about 14 times last year 2019 earnings. So if we assume that 2020 is an earnings washout, but next year we recover to the 2019 earnings level, the market's still at a 14 times forward earnings, which is generally not a rich multiple when considering 10-year U.S. Treasury rates are less than 1%. So one might ask, is this multiple too high? Is the earnings estimates too high? Well, don't know, but the market traded about 14 times earnings during the last correction at the end of 18, and it's bottomed much lower than that in the history, including touching down at 10 times earnings in March of 09 and the bottom of the financial crisis and 6 times earnings in the summer of 1981. So we might conclude that we're in the range of the bottom. There's still risk. In the last 2 weeks before the lowest close in the 09 bear market, the S&P plunged another 20% and then immediately took off on an 11-year tear on upward streak. Since the key to sensing the rebound after an earnings recession is forecasting how long the earnings recession is going to last, we need to think through a key variable. And this is the variable, of course, of the virus. The coronavirus cases are still in a logarithmic growth phase in the United States and other countries. But we're also watching China's progress. The sudden leap into the action by our government, the rise in available test kits, without places to gather like restaurants and bars, schools, and workplaces, we're all forced to physically distance ourselves regardless of our inclination. Using information from Johns Hopkins University, a leading medical research organization, we can extrapolate to the U.S. from China, suggests that spread could fall significantly in less than 2 months or by mid-May. If life, if we used to know it, resumes in the second half of this year, corporate earnings will begin to rebound the latter part of this year and into 2021. How does this compare to other recessions such as 2008? Well, the Great Financial Recession was caused by reckless behavior of just a few large institutions, i.e. banks, employing millions of people. This recession is being triggered by the forced shutdown of million innocent small businesses employing much smaller workforces, much like 2011. In 2009, there was a concentrated bailout to the largest banks. Recently, Congress has communicated intentions to distribute monies to the public, and that small businesses, restaurants, bars, retailers, and almost all industries will receive some relief for their business and their staff. This time, there's a huge government support that's coming out to the masses. So, for the time being, let's cautiously stick with an estimate of the earnings, the S&P for next year, of 165, and the stock market bottom of somewhere close to where we are, around the 2000 level for the S&P 500. And as we speak, I had a text that the markets are opened up about even. It feels as if there may be some exhaustion of selling at this point, which usually projects the bottom is near and attractive forward returns in the future. So in these uncertain times, step back to get perspective. Take a moment to think about your future, knowing that these days of darkness will pass and the sun will shine again. Call someone to check on them. Ask how they're doing. Let them know that you care. I have been blessed by many people reaching out to me. Thank you. So be steadfast, and thanks for tuning in for the MCF Perspective Moment. See you soon.